Welcome to the final daily briefing for the year from ofInterest.co.nz. I'm David Chaston. We'll have more details on our summer schedule at the end of this bulletin. But first we look at the pulse of manufacturing in New Zealand. We also review the latest trends in mortgage and term deposit interest rates, and we'll finish with a wrap-up of some other relevant stories of interest. Business New Zealand has released its latest survey of the performance of manufacturing, the PMI, and it makes very encouraging reading indeed. All 5 components of this overall index continue to show expansion, now for the 4th consecutive month. New orders lead the way with the largest value since October 2006. This was closely followed by strong production. The employment component had its highest value since November 2003. Results for the various manufacturing industries were positive throughout November, with some sectors showing significant activity. Petroleum, coal and chemical sector had yet another strong month. The food and beverage sector recorded its highest level of expansion since November 2002. All regions of the country shared in this expansion. Although it was reported that the exchange rate continued to be the main bugbear for manufacturers, they are clearly learning to live with this and are adjusting themselves to accommodate it. We are lucky to have a relatively large and booming economy next door, with an even stronger exchange rate than ours. One big story this year has been the rise of mortgage rates. We started the year with 2-year fixed mortgage rates at 8.1% and finished the year at 9.3%. Most of this rise happened in the first half of the year, before the international credit crunch started to bite in August. We in New Zealand have been fortunate that our banks have not been caught up in that crisis, and credit is still being freely available here. Risk premiums have risen, but in the international flight to safety, benchmark rates have fallen by almost as much as those risk premiums have risen. That has meant that only modest rises since August to our mortgage rates have happened. We are very vulnerable to the risks of the credit crunch, however. If those benchmark rates stop falling, all the rises in the risk premium will flow straight to our mortgage rates. Let's hope that does not happen in 2008, although you would have to say the chances are quite high. The big term deposit story for this year has undoubtedly been the string of finance company collapses. The 3 in 2006 have been followed by another 9 this year. Confidence in the finance company sector is at rock bottom lows. And given some of the stories being reported by receivers, when they've gotten in and opened the books to full scrutiny, a number of worst fears have been realised. It's hard to see a full recovery in 2007, and certainly be years before confidence in the sector fully returns. But there is much more to the term deposit market than the finance companies. Perhaps an even bigger story for 2007 has been the stunning rise in real after-inflation returns for term deposits. We started the year with a 1-year bank TD yielding 7.3% when inflation was 2.6%, giving an after-tax effective yield of about 2.3% for most people, less if you're on the top rate. We've ended the year with a 1-year TD yielding 8.9% when inflation is 1.8%, giving an effective after-tax yield of about 4.2%. That means about a doubling of net returns in 1 year, a very good result indeed for investors in term deposits. It may be the best results in at least a decade. And we think there is reason to expect the good times to last well into 2008. Inflation is low, there are new pie products hitting the market to take advantage of a tax advantage, and there are no signs that headline interest rates are about to fall. And because term deposit returns have no management fees and are not subject to market volatility as much, they will continue to be attractive to many investors. Collectively, New Zealanders have about $85 billion invested in these products, and that is about 3 times the country's annual exports. It's a lot. And finally today, a wrap-up of some other items of interest. By far the biggest international story of 2007 was the credit crunch. We recommend you check out the analysis by Martin Wolf of the Financial Times, which you can link to on our news page. He is sure the credit crunch has led us to an historic moment in the world economy, and he gives some compelling reasons. The biggest story in our local economy has been the rise of the dairy industry. Now Fonterra has announced a further update of their dairy payout to farmers, and it's all good news. It appears that an extra $3 billion will make its way through the economy, and in fact when the current season is over it could be even more. This is our last video news segment for 2007. These bulletins will be returning after the holiday season in a new and improved version, starting in 2008 on Monday the 14th of January. But all our other services and updates will be carrying on unchanged. You can still stay up with the latest rate changes and the latest news and background information relating to what drives our interest rates from all the usual resources on this website. Important things will be happening, like the GDP announcement on Christmas Eve. And of course, we'll continue to follow all the twists and turns of the credit crunch. Enjoy your holiday break. We'll see you again in 2008.